Thanks very much, and good afternoon, everyone, and welcome to the fifth session in our ESG Demystified series. We're delighted to provide a spotlight session today on the higher education sector. We're going to be showcasing King's College London's landmark sustainable financing framework, the first for a UK university. I'm very pleased to be able to hear from Simon Cruikshank, the Chief Accountant at King's College London. We're also going to hear from Dr. Arthur Crevers, the Head of Sustainable Finance for Corporates. For those of you that are new to the series, just a quick reminder, if I can, in terms of there are 4 previous sessions. It's been put together to be accessible for Treasury and Finance staff, taught by a range of both NatWest and external experts, and obviously focused on ESG aspects that are most relevant for public sector clients. The critical part of this is that curriculums are completely shaped by your feedback. So if there are things that you would like to see, please feel free to suggest them. We can incorporate it into future sessions. So just moving on to today's session, if I can, on the next slide, is we're going to hear from Arthur, primarily just around an overview of sustainable finance, drilling into and being a bit more specific of what we see across the higher education and university sector more broadly, and then move on to hear from Simon around the context, background to the choices that King's College have made around the sustainable financing framework, but I suppose more personally and probably of more interest and insight is just understanding some of the nuances and rationale for the choices made, but also the key takeaways and lessons learned. So we hope to find it insightful. At the end of Simon's session, we will have Q&A, so feel free to submit the questions that we've got. You can do that via written format. Be more than happy to take Q&A at the end. So without further ado, I will pass on to Arthur, who's going to lead us off.
Thank you very much, Dominic, and good afternoon all. Indeed, to set the scene in terms of the sustainable finance space, we turn to the next slide. It's come a long way, this market, from being virtually non-existent about 10 years ago to having recently crossed the $1 trillion outstanding. And why is that? Well, it is because it's been adopted by an ever-broadening range of sectors and geographies, as you'll see in some of the other pie charts there. And this concept of linking your debt issuance to your sustainability goals and objectives as an organization really emanated from different parts of Western Europe and indeed from development banks in particular. But what we've seen in the last 4 or 5 years is that it's broadened. It's moved into various corporate sectors. It's moved into governments, and critically, it's moved into the public sector as well. And again, it has become global. If we zoom in specifically on the higher education sector, go to the next slide. We've really seen the adoption of sustainable finance debt instruments to support, I guess, 2 main categories of activities. The first one has been, I guess, quite obvious, has been focused on the core business of the sector, providing education, and in many cases that's then been overlaid with specific educational priorities, whether that comes typically when it comes to supporting disadvantaged groups, and again thinking about some of the UN Sustainable Development Goals, which relate to education and making it affordable and accessible to all. You see a couple of examples on the slide there. The other element where we've seen sustainable finance debt issuance being adopted has been around decarbonization of the buildings managed by the sector. So whether that is the campus environment or indeed some of the accommodation as well. And I think an interesting recent example is Unite students coming out with their financing framework. And what's I think very noteworthy about the King's College framework, which Simon will talk to, is that it really encompasses both those main areas and indeed several other categories that you hear about. So it takes quite a quite a holistic approach. But certainly when it comes to this sector, we see opportunities to earmark and to appeal to investors, both from an environmental and from a social perspective. In terms of some of the key reasons that we're seeing issuers in the higher education space look into this type of solution, if we go to the next slide, that there's I guess, three main drivers that we tend to notice. And the first one is that for a lot of our university and higher education clients, there's quite a advanced and elaborate sustainability strategy already in place that really permeates the organization. Now, there's lots of things that a finance function can do to contribute to that in terms of its day-to-day operations, how it manages its cash, for instance, and how it thinks about reporting and investor relations. But arguably the most tangible thing that a finance function can do is to come out with one of these financing frameworks. It really has a loudspeaker impact in terms of reaching a broad range of stakeholders in the investor community and in the wider community, and in terms of very concretely linking your debt financing agenda with your sustainability priorities. So that's the first reason. The second reason that often comes up, and it's often referred to quite loosely as sort of the broader PR and marketing benefit. When you are speaking to investors and stakeholders about this financing framework, it often is a very good vehicle to talk much more broadly around your sustainability ambitions. When you have a typical debt investor meeting, clearly the focus often is on more traditional credit story and credit ratios. When it's a debt investor meeting in the context of a sustainable finance framework, suddenly you can have a much more open conversation around your ESG priorities and your sustainability priorities more broadly. Then there's a final element that's really emerged in recent years, namely that it has a real economic impact as well. We're now consistently seeing that organizations that add a sustainability component to their financing tend to draw in more investors, tend to draw in newer investors, and as such can help strengthen their access to liquidity and to financing. When there's such a demand amongst the investor community for sustainability investments that it becomes a lot easier to get people's attention, even if you're coming out as a relatively unknown borrower or relatively new borrower to the capital markets. So that's me by way of introduction, but let me hand over to Simon to talk through the specifics of the KCL framework and lessons learned.
Thanks, Arthur. So just to introduce myself, I'm Simon Cruikshank, Chief Accountant at King's College London. Role I've had for about 2 years, and we've been working with NatWest in the last kind of 6 to 8 months on some financing alongside the sustainable financing framework. So if we turn to the first slide in my deck. So I guess the big question for us was, why is sustainability important for King's College London? And we really feel that sustainability is core to what we do, not only to what we study, we research, but also how we operate. So as an institution that's approaching its 200th anniversary, you're hopeful that sustainability is something that's got in mind, and that's what's got it there. And so we have a strategic vision to 2029, which is our 200th anniversary. It's not just a random number. That kind of takes that on board, and that's where we're working to. And I think it's all sorts of types of sustainability. So from kind of financial sustainability, economic sustainability, both of ourselves and of industries and subject areas that we support, through environmental, through our work on air quality, environmental research, but also our own commitment to make sure we're doing the right thing environmentally. We've recently just gotten fossil fuel free in our £250 million endowment, which was a big move for us as well. Social systems and political sustainability and human sustainability. So we've got one of the largest medical faculties in Europe, and a big part of what we do is about keeping people alive, which is a fundamental part of one element of human sustainability anyway. So King's takes this stuff very seriously, both in terms of what it can do, but what it can encourage the world to do. as recognised in the Times Higher Education Impact Rankings. I think we've just slipped to 11th. Actually, there's new rankings out. Congratulations to Manchester for topping that one. But we're interested in lots of these ways that we can contribute to the advancement of the world. And so the sustainable financing framework is, as Arthur said, one of the ways in which a finance department can kind of take a step forward into that space where the rest of their colleagues are working very hard. So on the next slide, we're describing here what the key elements of the sustainable financing framework are and how they've worked at King's. And this is kind of a framework for some later slides that we'll go through in detail, but it seems like an awful lot here, and we'll talk through them a little bit more and add a bit of colour. But largely what we're talking about here is defining what we're going to be using the money for, which is use of proceeds, working out how we select projects in, which is the project evaluation and selection, looking at how we record the information about those projects, which is management of proceeds, how we then report them, and then how we get reviewed to make sure that we're aligned with the things that we've said we're going to do in our framework. So I think it's probably best to turn to the next slide and have a look in a little bit more detail at some of these. So we've got here use of proceeds, and this is really the core part, I think, for me, of where the sustainable financing framework came about, and the bit where all of the effort goes really is to identify the types of things that you're going to be allocating this funding against. And we've gone for a sustainable debt raise, a sustainable financing framework, which is a combination of the ICMA LMA principles for green and social projects, social debt. And we really wanted to hit some of those notes in both categories. So on the green side of the screen, you can see a range of things that are actually fairly concrete. Concrete's probably not that green, but fairly clear things that you're able to manage and badge. So from green buildings around your BREEAM status or your SKA kind of refurbishment certificates, your refinancing of existing buildings with those certificates, or your enhancement of the buildings in a green sense in terms of energy efficiency, either in capital sense, or actually looking at your renewable energy purchasing. So King's has quite a commitment already, very high commitment already for all of its new buildings and all of its refurbishments to be either improvements or for new buildings, BREEAM excellent or very good. We already buy renewable energy, so all of our electricity is green already, which is something that helps us include this category here. And then there's some smaller areas, but no less important, around clean transport. King's is a campus, a city-based university with many campuses. We don't have a large fleet, but that fleet we are slowly moving over to electric vehicles. And the social side of things, I think, a little bit more tricky. And this is where we spent most of our time actually in discussions with NatWest and latterly in the process our second party opinion providers, Standard & Poor's, around what we could include about the fundamentally good things that universities do. And this was our biggest challenge, was trying to translate what we believe universities are very good at into effectively finance industry speak, which was something that we got a lot of help from NatWest on actually. And in there we've got PhD studentships where we're making financial contributions to those. And we originally started looking at those broadly for all PhD studentships that we invest in. And we actually twisted this so that they were more clearly aligned to the UN Sustainable Development Goals, and looked at the particular subject areas of medical, dental, education, hard sciences and social sciences programs. We also looked at some of the things that we do as part of our institutional mission around women's development and the Institute for Global Women's Leadership that we have headed up by an ex-Prime Minister of Australia, and our kind of internal commitment and external commitment to equality and diversity, and including those. And possibly the more interesting one, I think this is the thing that you will only get at a university, is the inclusion of access and participation plans in our potential use of proceeds. So we're a fee-capped institution, like probably a lot of you on the call. We charge £9,000 fees. That requires us to provide a bursary scheme, and we've included that within this because there's a means-tested element to that in what we do. So use of proceeds was where we spent most of our time investigating the things that we should be including to make sure that we've got a collection of both green and social aspects towards our sustainable issuance. Can we have the next slide? So process evaluation and selection. So this is really having defined, this is what we're going to count as sustainable finance use of proceeds, we then have to go around and find the things that we need to select in. And this was important when we were doing, at the same time we were doing a debt raise. So we had in mind a number that we were trying to work to ensure that we could do that. And here what we're saying is we'll have a governance framework stood up in order to look at the things that should be opted in, look at things that have previously been opted in, because this is a framework that will continue until all of the use of proceeds are allocated, to make sure that the things that are in there are still valid against the ICMA principles, but also we haven't disposed of the building, for example, or sold it. And then it kind of oversees the reporting process internally within the institution. So it's another key aspect of the framework, another key aspect of the expectations from ICMA, but fairly straightforward and kind of piggybacking on existing processes and the staff that we already have internally. So the next slide is about the management of proceeds. And this is really about just tracking spend, making sure that we've got the totals that we need to for the issuance that we've issued under the Sustainable Financing Framework. And here it's a fancy way of saying effectively making sure you can track the various aspects that you need to, both in terms of the certificates that we've got for the green buildings, but also the actual spend that's going through the finance system. We've got the invoice vouchers for our green energy spend, etc. So fairly straightforward, but just another way of looking through the accounts to try and find the information that we require. The other thing is around setting up a monitoring process to make sure that if we are opting assets out, we've got something else to opt back in again. I think the key thing here, and the tip that we got from the NatWest team, was around the Treasury policy that unallocated funds sit under. So the institution is borrowing this, has set up this framework to borrow some money to invest in a capital plan that may extend for a number of years. And so we may not be spending all the money immediately. What could we do with that money in the short term? And so the important thing here was that we were able to use our usual Treasury management policy to place this excess funding whilst it's waiting to be invested in some of the items that we've got, which is something that we made sure was in the framework, which I think was really important. So management of proceeds is fairly straightforward. And then reporting on the next slide, this is actually just making sure that we're able to use all of the selection criteria, the information that we've collected in reporting, and actually provide reporting on what we've done. And there's two aspects to reporting. One is to make sure that we're allocating the right use of proceeds to a particular total for a debt issuance that we've done under the framework. And the other is to attempt to provide a range of impact reporting, because people really want to know what's happened with this money and what the impact has been. So whilst it's great to be saying that we're spending a certain amount of money on green energy, it's also more important, I think, to be saying how much carbon we've effectively avoided by not buying gas, for example, gas-fired electricity. And so impact reporting is also quite important in this space. For the green aspects, I think what we said at the beginning about use of proceeds, some of these things are very clear, they're very cut and dried. There's a certificate, there's a calculation that can be done in kilowatt hours. For the socio-economic advancement and empowerment, access to essential services, those areas in purple at the bottom right of the screen, these things are a little trickier, and actually outcome measures for these things can be quite difficult. So for example, if we have a medical research student and their research is into a particular type of drug and that comes off, that might have an impact in 20 years' time. It's not the kind of thing that you can capture in this. So in those areas, more of what we're doing there is measuring the input measures. How many students have we supported? How many scholarships have we offered to asylum seekers, which is another strand that we were looking at? And how many people have engaged with the inclusivity projects? And how many hospitals have we supported to revolutionise their A&E approach in sub-Saharan Africa? So some input stuff there, which I think actually adds some real colour, but also kind of context to the funding and the investments that have been made by the institution, which I think is where the power comes in the conversation. So that's reporting, and then we've got review, which is the next slide, which is the final element of 5. And the slide here focuses on one aspect of reporting, but there is actually another. So the review here for this Sustainable Financing Framework. So you set up a framework that says, I'm going to do these things, I'm going to measure them in this way, I'm going to report in this way. And what we've got here is an agreement or a statement of alignment from Standard & Poor's as a second party opinion that our sustainable financing framework, all of the things we've talked about before, are in line with the ICMA green and social principles that we have to hit. Excuse me. And that's really important, because what that does is it provides the assurance to the people that are lending you money that your framework that you have written, and you may have had help from advisors like NatWest to write that, is actually a valid interpretation of what the expectations in the finance markets are, so that when the credit committees are offering new funding on the basis of a sustainable bond, they can go back and say, I have actually invested sustainably. And this is about creating a golden thread through to make sure that everybody is clear on what the funding is going to be spent on. And NatWest went to great lengths to help us with the Standard & Poor's appointment. We went through a beauty parade with a number of providers. It was interesting, actually, because I think this is a fairly new area, not just for universities, but actually, as Arthur's saying, for lots of different sectors. And so the providers in this space were offering very different services. So some were offering to judge us on ESG as an institution, some were offering to assess our framework, and some were offering to do a combination of the two. We were on quite a tight time frame to do this, alongside an associated debt raise. And Standard & Poor's were able to do this fairly swiftly, because they took a very narrow focused view on the sustainability finance framework assessment, which is what we were after. We also had the benefit that they offer us a credit rating annually as well. So they already know us as an institution. So that relationship worked very well, but we were very pleased to go through the beauty parade process and assure ourselves that we were getting the right second party opinion provider. In terms of external review, there's also a requirement in our sustainability financing framework to do annual reporting and have that assessed by an external auditor. And so not only are we doing the recording and the monitoring, the reporting, we're also having to go through an audit. We haven't done that yet. We haven't completed a report yet. The debt raise that's associated with this isn't going to have funds flow until June. We are lining up an audit team to do that, and it should be fairly light touch. So I think what they're doing is they're tracking that golden thread through from the sustainable financing framework, through our allocation process, through our review process, through our reporting process, and they're just making sure that all of those things line up back to the thing that Standard & Poor's have said is aligned to the ICMA principles. So that's the external review. Can we have the next slide, please? So just, I guess, to wrap up, we'll just move on to the next one. Just a couple of key takeaways. So we went into this with our eyes open, I think, about what we were capable of counting in this kind of green and social space. And we did quite a lot of analysis to make sure that if we went down this road, we were able to create a list of use of proceeds in a reasonable amount of time to cover any debt issuance that we were going to raise under this framework. And that was a really important piece of work to make sure that we were happy with. Because depending on what you include in your countable categories, that depends on your ability to easily or not easily make your use of proceeds total for any particular debt raise that you have in mind. I think also the second party opinions, the SPO, we really needed to make the right choice there. As I said, we were on the time clock. Excuse me. We were on a time constraint there, and we needed to make sure that we got the right outcome, but also we got a clear outcome, and I was really pleased with how that one went. I think the challenge that we had, I think I mentioned briefly around the studentships, both the taught studentships and the undergraduate space and research studentships, was being the first people to take this step was kind of an uncomfortable position to be in. And we got quite a lot of confidence from the experience that we were offered from the NatWest team and in conversations with our second party opinion provider that if we gained real kind of tangible alignment with the UN sustainability goals, then these would be includable. And I think hopefully, having done this ourselves kind of first in the sector, we understand it should be easier for people to follow now, because I think there wasn't a precedent before, and that was quite challenging, I think, for our second party opinion provider, but we got where we needed to go eventually. But none of this is possible without kind of a lot of input from other people. And as finance professionals, I don't know what the mix is on the call, but I have a passion for sustainability and green issues and environmental issues, but I'm not knowledgeable and I can't speak to them in a compelling and convincing way. And getting people that can do to support you is really important. So we had great support from our estates colleagues, great support from our sustainability colleagues in the estates team as well. And we got great buy-in, I think, from lots of our mission-based VPs. So at King's, we have a VP for service, we have a VP for international. And these things really spoke very positively to their own missions. And all those things together and get a cross-disciplinary team working internally, I think that gave us a real boost in terms of explaining ourselves to the outside world. I think also having good external advisors was really key as well. So I think, taking a holistic university-wide approach is really important because it allowed us to include a range of things that kind of kept a variety of people happy, but also it gave us an opportunity to burnish our kind of credentials in lots of different spaces under our framework. So that was the experience that we had. I think we're turning to questions now, and I think Dominic's going to lead us through those.
Thank you very much, Simon, and thanks also, Arthur, for setting the scene. Very interesting to hear from you, Simon, from first hand in terms of how that's gone. We'll say to everybody on the line, if you want to ask a question, please do so. The type function will allow you to ask the questions. But we have had a couple of questions in while the webinar's been going on, and perhaps I'll start, Arthur, with yourself, if that's okay. And this is more around, given this is an inaugural framework from a university, do you think more universities will follow suit in establishing an ICMA aligned framework?
I think that's very likely. I think what we've seen with other sectors is that once you've had a number of first movers, such as King's when it comes to higher education, once you've had a number of first movers come into the market, there's this sort of S-shaped effect where you start to see accelerating take-up amongst other major issuers as well, and gradually the conversation moves from why should I set up a framework to why shouldn't I. And it becomes even more of a defensive play because more and more of your peers have already gone down that road. And as Simon has put it very eloquently, I think the higher education space, more so than some other sectors, has a lot of sustainability strategic components and indeed also stakeholder pressure that it has to deal with, which I think lends itself to a quick uptake.
Thanks very much, Arthur. And if I can, Simon, there's a question that's come in asking around what the key challenges you faced from an internal perspective have been regarding the establishment of the framework. I'm back. I think there's a couple of things really. One of the biggest challenges was I think I mentioned it in the presentation, was just trying to translate what we believe is fundamentally quite a good sustainable set of activities that's core to what the university does into the correct language to be kind of considered correctly outside. So unlike a lot of corporates, which might quite large bolt-on sustainability arms, rationalizing what they're doing and kind of putting a lens through that, sustainability is kind of core to everything that we do. And so not having a single person that was going to look at this was a little challenging, and trying to key into how the fundamental good stuff in education, research, service at King's, the three areas that we focus on, can fit into this type of framework. I think there were some practical challenges as well. I think when you go into an institution and say, we're looking to start something and we may have some money that follows it in terms of an associated debt raise, people get very excited about spending new money. And so what we were very careful to do was, when we went to the people buying the utilities, we don't want more utility spend, we just want your utility spend. So green energy is good, but not more green energy. And so at universities, I think, traditionally we see ourselves as
organs of spending, really, because through spending we get things done. Trying to dampen that down slightly in some areas was often a challenge. It's not always new money, this, because there's lots of buildings to put up.
Great, thanks very much, Simon. And perhaps a follow-on question while you're there, Simon, is questions come in saying the socioeconomic advancement and empowerment areas around PhD research, training and development are super interesting. Can you talk through that section of the framework and how you arrived at sort of the projects that you did select from that?
Yeah, so we started off with the basic point of, education and access to education is good. And we wanted to include our PhD areas because we do spend an awful lot on our PhD studentships, either ourselves or through matched funding. And we started with the point of view through this process of just including them as an access to education, as UN Sustainability Goal 4, I think it is. I'm going to get my numbers wrong. And the challenges that we had there were that a lot of that funding is associated with merit-based appointments rather than means-tested appointments. So we twisted how we looked at it to still include them, but focus on the actual outcomes for society that we hope our students will be producing. So we have a lot of medical and dental students on funded PhD studentships, which are either going into new medical fields, existing medical fields, or possibly back into medical systems overseas. And we wanted to recognise the benefit that training and education in that space offers to the world, in line with some of the key things around the UN Sustainable Development Goals. We're not sure yet whether we're going to trigger the use of that category. But the idea is that we will, if we do so, we'll have our graduate school assess the range of research topics in particular schools at the college to assess their alignment to a UN Sustainable Development Goal. So we have people doing PhD study in sustainable cities as well. And so there's all sorts of a kind of range of things that we could include there. And we think it's a kind of unique way in that you're not going to get from someone that isn't at university. So we wanted to include something that was really wholly a university thing. So we're keen on that.
That's great. Thanks very much, Simon. And as the question said, it is super interesting. Arthur, if I can come to you now, there's a question here is whether or not you have an expectation. Perhaps Simon can add his thoughts, but whether there's an expectation on the pricing benefit of a university establishing this kind of framework, particularly around capital markets issuance.
Yeah, it's a great question, and it's one which would have been quite clear a few years ago. At the start of this market, it would have been clear, no. Investors would have said, well, I'm getting the same risk exposure. There's no different governance or collateral involved. However, in the last certainly 2 years in the UK capital markets, that this idea of a greenium has become quite well established. And it really is a result of what we were discussing at the start of the presentation, that you've got a larger order book, and often also a slightly less price-sensitive order book, because investors are participating not just out of financial considerations, but also to meet the sustainability goals that they have in their portfolio. And often holding a sustainability debt instrument is a very much a flagship holding, a very good way for them to meet those goals. It's hard to throw out a definitive number, because it will depend on the all-in spread and yield context of the transaction. So if it's a longer tenor, if it's a more slightly weaker rated issuer, that overall yield is higher, so there's more to play with and more to try to negotiate down. What we've tended to see in the UK markets is that it's anywhere from a couple of basis points through to, again, amongst the weaker rated names, it can even be 15 to 20 basis points. Which, if you're thinking about say a benchmark bond issue or a larger private placement and need a longer tenor, can be some real meaningful savings that are possible.
Fantastic. And I don't know, Simon, if you want to profess a view on that question or not.
Yeah, no, happy to. So we went into this for I guess two reasons. One, a lot of the mission-based stuff that we've spent most of the presentation talking about, and having the finance function at King's engage really heavily with that agenda at the institution. Also the possibility of, frankly, some kind of some demand advantage. So if more people are interested in lending to us, then it drives the credit position into a better shape for us. It's hard to tell whether that's happened or not, but I guess what I'd say is that the costs of putting this type of thing together are fairly minimal when it comes to considering a debt instrument that might go out for 10, 20, 30, 40, in our case 50 years. That anything that you can get anywhere on the basis point is really going to help you. Because that money adds up over a long period of time. We're finding it difficult to see whether we benefited financially in that space. It's very hard to kind of draw that direct line, but we certainly had an awful lot of interest when we went out to market with a piece of debt that was associated with this. And I'm still very pleased that we've taken this approach. And I think it was the right thing to do. So I think certainly if you're going out long, then every little helps, I think.
Thanks, Simon. Appreciate that. I think we do probably have time for one more question. I do apologise, Simon. I feel like I'm picking on you, but there's another question for you. It does relate around the sort of establishment of the programme. So, just saying, can you summarise the internal involvement on the establishment of the framework? And the question is more specifically on from a governance perspective. What measures did you have to put in place, and what oversight did you need to have on the process and also on the establishment of the programme?
Yeah, so I guess from the establishment point of view, we undertook this exercise at the same time we were seeking some external debt, and so we already had some committees stood up around finance, our finance committee considering this, and we dealt with it as kind of two streams in one task. So we had the benefit of a lot of focused time from governors on this. And so we presented our draft financing framework to a debt investigation group that was a subset of the finance committee, and presented the kind of rationale for why we were doing this, why it was important, and why we wanted to push on with this agenda. So that's the kind of the startup. So I think if you're doing a debt raise at the same time, I think it's a good time to do it because everybody's sharpened up to these types of things. It's tangible. Then the benefit of doing it is actually tangible if you're looking for either making a splash in the market or attracting new kind of debt offers. And then in terms of the ongoing, we're in the process of standing up the committees, but we're going to have an annual committee that has a terms of reference that sits under our senior leadership team that looks at the use of proceeds and goes through the steps that we've presented in the presentation. That will assess whether we should be including things or not. And so I think it should be relatively light touch, although the reporting is quite important in terms of pulling together some of the impact stuff. And one of the things I didn't say actually in the presentation was that King's already does quite a lot of impact reporting on the green side. So we do issue a public document once a year that will help in a lot of that impact reporting on the green elements. So some of that infrastructure is already there, and it's just trying to bring some governance around that satisfies the framework that we've put together. So it shouldn't be overburdensome.
Great. Just conscious of time, but probably leaves me to say thank you everybody for joining the webinar. We hope you found it useful. Please feel free to provide feedback, but I suppose more importantly, thank you to Arthur, but for Simon for his time and insights in terms of the process that King's have been through. And thanks for joining us, and we'll see you very shortly.